I think the key to financial market performance this year will rest with the bond market again. That's what we saw last year. This transition of activity in the bond markets from central bank intervention as they hand over control of bond markets effectively back to private investors and market forces. That could be quite disruptive. And so, it looks like a smooth transition at the moment. There were some early stutters with the taper talk, and that was quite disruptive midway through last year. But financial markets seem to have become a lot more comfortable with this transition and tapering of the asset purchases of the central banks, and particularly in the US. But that transition, that handover, if you like, from central banks to private sector investors and market forces, that could be far more disruptive. There's a lot of uncertainty around the inflation, deflation trends. Inflation's been absent for a long time, and there's a real complacency around that. But there's some early indicators to suggest that we may see some rekindling of inflationary forces, and that's exactly what the central banks are trying to engender, some improvement in inflationary forces, because they're terrified of a debt deflation trap, which some economies have clearly been in. So I think that's the focal point for investors in the year ahead. The deflation-inflation debate, impact on bond prices, the transition of control in bond markets from central banks, which are basically buying all the new issuance of treasuries, back to market forces, and that can be quite a disruptive process, I suspect.